what I think is really important for people as they try to understand how deals are done. You had a core competency. You knew retail, you knew this asset class, you had the company and the team to execute on a plan. And that conviction was enough for you to have the confidence to continue to fight for the deal. And you could have given up, maybe 10 times and the deal would have died? I mean, at the beginning when you're raising
Sometimes
capital,
I was ready to and you wouldn't let me.
Welcome to ReTales. I'm your host, El Warner. Today we're going to sit down with Chris Nicholson, the president of Milan Capital, to discuss one of my favorite stories, Camarillo Village Square. This is a 250,000 square foot shopping center located in Southern California, anchored by Sprouts, Rite Aid, and a few other great tenants. I was fortunate enough to sell it to him in May of 2021 and sell it for him in February of 2023. And he made a $20 million profit. And I'm looking forward to sharing this story with you. Well, Chris, welcome to ReTales.
Thank you.
We created this podcast because, as you know, many of our clients are always asking us how, as brokers, how are they going to make money in real estate? And what they often see is they see Camarillo being purchased and then they see it being sold. And they look at it and say, we buy low, we sell high, and that's how we make money. And what I wanted to do is really dig into these stories. You were obviously at the forefront of Camarillo, and I thought it was amazing execution. And I feel like it's great for the viewers to see what it really takes to get these deals done. So a little bit of intro. Obviously, Chris Nicholson, president of Milan Capital. 2 million square feet owned, an additional 1 million square feet leased.
1.5 million now managed. Yeah.
1.5 million managed.
Yeah.
What I love most about your bio, and also in Camarillo, you sent me an LOI with a full cover letter, was that you said that 90% of all transactions you closed.
It's true. Yeah, we've been in escrow since I've been with the company for 22 years now, almost 23. We've been in 25 escrows and we've closed 22 of them. With the ones we haven't closed, one, there was an environmental problem that no one knew about. One, the seller was just outright lying on the rent roll. The rent roll was completely fabricated. And then the third, we ended up closing later. So
I don't see average days in escrow often.
well, that's a whole other story as we'll talk about. Yeah, sometimes the deals take a little longer. We I could almost count the one that we didn't close in 2018 but closed in 2021 as one escrow.
Yeah. So it's really 23 out of 25 deals you've closed.
Yeah.
Your ratio went up.
Exactly.
And the reason why I wanted us to talk about Camarillo was I felt like it was a great story from buying it, creating the value, and then exiting, because the time frame that you owned it, and we'll get into the dates, was, you closed on it in May of 2021. And then you were looking at it in 2020, which is an interesting time.
Yeah.
And then you sold it this year in February of 2023. So it was a very quick timeline. And fortunately enough, I was able to be part of it when you purchased it and part of it when you sold it. And watching you do that was pretty interesting. So I wanted just to start with the beginning and ask you some questions on it and go into a little bit more detail.
Yeah, absolutely.
So I think what's interesting for me was I remember the call that I got during the pandemic. I think it was June of 2020. And during that time, as you remember, everything was shut down. I think myself and my family rented a house in La Quinta for 3 months. We were really kind of staying in place.
Perfect in the summertime because it's nice.
Yeah,
nice,
exactly.
nice place to go.
It's perfect.
Starting
yeah,
in June.
It was cheaper then.
Just escape Newport Beach.
Exactly. It was actually March until June. It got so hot I had to come back.
Yeah, that makes sense.
But I remember I got a call from a client who needed to sell this property. It was one of the few assets that didn't have debt on it that they could defease. And they were in escrow at 61 million and change. And someone came to them and significantly asked for a price reduction. And he calls me and said, El, do you think that, you can get 61.4? Do you think it's worth that? Or should I take this 50 million and change? It wasn't actually 50, mid 50s. And I thought to myself, I think we can get that. And I had one choice to make one call. And I realized that the one person that I needed to call was somebody that understood retail at a good level, was very entrepreneurial, and was an optimist. I wouldn't say cheerleader, but someone that I knew would be very excited about the opportunity and can get this deal done, because June, July, August of 2020 was a very difficult time for especially retail. So Do you remember getting that call, or do you remember when the deal was brought to you, and walk me through that?
Yeah, I think it was maybe a little bit later in the summer is my recollection, and things things had gotten a little better, things had started to open up,
Yep.
but then different variants of COVID were coming back, and so it was challenging. But what I do remember is around June, from March through June of 2020, I don't know if this is optimistic or pessimistic, but I was telling people, now's a great time. I had taken money out of the stock market in 2019. I put it all back in March of 2020, figuring we'll be rich or we'll be dead, right? I mean, those are the two options, right? I mean, there's not. So I think we felt the same way about a deal like Camarillo. And a lot of times when you're buying these value add deals, you really have to be looking at things when no one else is looking at them. When other people are running away from those kind of deals is the exact moment when you want to be looking at them. You know, there's certain of the deals in the whole spectrum of the whole world of deals that you could do that don't make sense for all the reasons that everybody's running away from the deal you might be looking at. But if this deal has certain attributes that are going to be enduring, it's a great thing to buy.
You know, that's very interesting, because I remember at that time, it was May of 2020, and I was also looking at the stock market and saying, this is a good time to get back in. I remember I put a house under contract. I invest more in the residential side than the commercial side. And I got too hesitant. I said, you know, I'm putting all my eggs in the basket, not only to make money in real estate, but to invest in it. So it's one thing to see it. It's another thing to get the guts and actually make that decision, which is a lot of people say, you know, it sounds great, let's do it. But I think a lot of people need to realize that you can believe that, but then to take it the extra step and actually do it is a different level. So I guess maybe let's take a step back. What was it about this specific property, in addition to the market, that you thought would be a good purchase at that time?
First off, it's a grocery and drug anchored retail center in Southern California in an affluent area. And it seemed to be one of the dominant centers in the area. If you looked at the placer data, looked at cell phone tracking data, that was the best community center. To own a retail to own a grocery and drug anchored center in Southern California, normally for the 5 to 8 years before 2021, you were probably paying in the 5 caps, right? And so your yield on cost was 5% or something like this. And in this instance, at that $61 million price, and I think initially we were talking about 63 or something, and 62 maybe, but we were able to back into a situation where we felt like, first off, there was meat on the bones right away, because there was a Starbucks lease with a 10-year lease with an urgent care drive-through Starbucks. We felt like we could spend that right away for a 5 cap or below and lower our basis, and then back into a situation where we were spending some money. So from the 61, it cost an extra $8 million, let's say, to stabilize. And if you add all that up, we were backing into an unlevered yield on cost, so without debt, of 7 and somewhere in the high 7s. So a full 250 basis point discount over where stuff we thought ultimately had recently been trading.
Yeah.
You know, and then on top of that, there was the opportunity to create further parcels and maybe sell off the KFC, which had a couple years of term left, low rent. We figured we'd stabilize that, and at the end of the day, we'd sell that off, and then we would have backed into with what the rest of what we owned at an 8% return on cost. So if you just look at those simple metrics, it's a no-brainer in terms of valuation. All those numbers have shifted up dramatically in the last 90 days with interest rates rising as much as they have. So you know, now that 8 might have to be a 9.5 or a 10. But it's still it's a fantastic deal.
Yeah.
And so you really have to be able to look at things that other people are running away from, and with legitimate reason too. I mean, this center was 25% fitness and restaurant, right? And of that 25%, half of them were not paying full rent, but they were all paying something.
Yeah.
You know? And that was our experience in our portfolio too, was these are small business owners who are not just going to walk away from their business. They don't really have a choice. They're going to be investing whatever they can to keep open. They're going to try and make the business work in whatever way that they can. And it seemed like the tenants at Camarillo, for the most part, were doing just that.
Yeah.
And so so that enabled us also to have a little bit more confidence that the 7.5 or 8 that we were backing into was really going to be there at the end of the day.
Yeah. Talking about the first part, which is the buy. I mean, people say they make money in the buy, and then obviously the second phase is value creation. The third is you have to sell it. You have to exit it at the right time. But going back to the purchase, just to simplify, when you buy something, so you're saying the market was valuing these type of assets in the 5 cap level, in the mid 5s.
A year before.
And you noticed that some of the challenges, this asset did have some potential challenges from a macro view, where someone could say, they could, if they were pessimistic investors, they could overanalyze the rent roll. They could overanalyze potentially Sprouts credit. They could get hesitancy with, is this business plan actually going to be executable? And you saw that and basically realized, not only do I believe that, yeah, there may be a small window of time that the rent roll could look unstable, I know I can get my team in here, stabilize it, and then ultimately, if I'm able to grow the NOI to a level that I take my total cost, which was $61 million and change, plus the renovation cost, lower my basis with a pad sell-off, which is a much lower cap rate. We'll get to what that sold for. Then what happens is, if I'm looking at, I'm stabilizing to a return on cost in the 7-8 range. So for you, the two belief systems you have was, one, I need to make sure that I can sell at this level, because then I don't lose people's money, right?
Yeah.
That's your downside scenario. And then you have to have a belief that you can execute on that plan.
Yeah, the other big moving part of that deal, of course, was that there was construction that needed to happen, and in 2 phases, right? Rite Aid needed to be downsized, and then there was a building, and construction was beginning already by the time we were starting to look at it. So it's also another thing that keeps people from buying those deals is that no one wants to buy a deal in the middle of construction. And also no one wants to buy a construction related deal without all the contracts being bought out.
Yeah.
So there were some moving parts there too. But we felt that we could fatten up the construction costs and still back into those numbers.
Yeah.
And then we also felt that, all right, if worse comes to worse, you're here at an 8 yield. Even if you can't sell it at that 8 yield, that's still a much better yield, unlevered than what you've been able to achieve historically for this kind of asset.
And so that made sense. And you submitted an offer, I believe it was around 61 and change, 61.5, and you closed it very close to that price. But that was in September of 2020, really October, and then the asset closed. During that period of time, the debt markets were challenged, equity markets were challenged. So it's one thing to have the belief, it's another thing to manage the actual capital stack. Walk us through, did you have the money at that time when you wrote the offer? Did you have to find the money?
No,
who did you find the money from?
How did you really have the money? No, we were considering a couple of exchanges. And so we had maybe the opportunity to exchange into this deal. And it's exactly the kind of thing that we like to own long-term for our long-term portfolio.
Yeah.
But I also felt like we'd be able to raise capital around it. What I did not realize, and when I think I wrote the offer in late October, the offer that eventually got accepted in late October.
Probably November that it probably got accepted.
Yeah, I got accepted in November. What then almost immediately happened was the Omicron variant took California into a second lockdown. So again, gyms had to close down, restaurants had to close down, everybody was shut down for another month.
Yeah.
And it was right at that moment that the exchange idea fell through, and we were trying to raise money for this deal that had all these challenges in October.
At that point in time,
now double.
So when that happened, so that's my point.
Yeah.
The true optimist, the guy that I need to find. When your money was gone, like you had money, it's gone.
Yeah.
You're going back into pandemic. You got to come up with $61.5 million.
$61.5 million. Yeah. We had like,
and was there a moment there where you we talked about it. I feel like there's 3 different parts. There was the buy, the creation, and the sale. Your hair volume grew significantly through that process. Was it a luck thing?
No. So the volume of hair, it became a thing where I said, listen, I'm not cutting my hair until the deal closes. All right. So I didn't realize
people finally had to give you money because they couldn't keep looking at your hair grow.
Exactly. It got scarier and scarier as I showed up at their houses begging for $1 million or $250,000 or whatever. So but I thought it would be, first off, I thought it'd be relatively easy. I thought people would see the value in this asset and what was a reasonably good level of return, even at our numbers which were more conservative than where we actually eventually executed.
Yeah.
So we thought we were going to exit at a 6.5 cap, and we'll get to that fantastic execution you guys were able to provide for us. But we thought even at those numbers, people over a 3-year period were doubling their money, which translates into about a 24% return on cost annualized for 3 years. You double your money. So that's well above what people in the institutional equity community are looking for. I thought it'd be easy to raise institutional equity. And I met with at least half a dozen and spoke with probably over a dozen institutional equity investors. They were all initially interested. I toured the site with them and toured the market with them multiple times in December and January, and people were very excited. And then they would come back and they'd change the underwriting. So no, you're being too optimistic, right? And say no, you got to be able to make money if you're selling it at a 7 cap here, and you got to hit this return. And by the way, we still make money at a 7 cap on that deal.
Yeah.
But just not enough to really hit those investment hurdles. So in the institutional investment community, there's oftentimes an idea that the problem that I have with that community is they flock to the same assets all at the same time, and then they run from the same assets all at the same time. And usually when they're running from those assets, we're interested in the assets they're running from.
Yeah.
Makes it more challenging for us. So we had to pivot and start looking for private investors and for people maybe that were in and maybe also provide institutional money a preferred position.
Yeah, that's a great point. I want to stop there for a minute because I think that's a really good point. When you looked at your capital that you had to acquire, you had an amount for equity, you had an amount for debt, and then you had an amount that was friends and family. What the point that you're making, I think, is really true is that you're going in an area where the capital is flowing away from, but the fundamentals are still strong.
Yeah. And
so you're having to utilize those fundamentals to go chase that capital. But the reason why the pricing is good for you now is because that capital is exiting. So that middle stack, which is you got the debt, which I think was 40 plus or minus million. You had the equity, which is 20-ish million, and then you had the friends and family at a smaller tranche. But couldn't go through that, which was the hardest portion of that capital to raise.
So at some point in time, we had 2 pretty solid offers on the debt, and they were both in the high 30s, low 40s in terms of total proceeds. But on a $61 million deal, let's say, with $8 million of extra cost, that you don't get all the 41 up front. So then you got to back out the $8 million of costs. So really it was more like 33 or 34 in debt that we were closing with, which left us a gap of about 27, 28. But we got the debt, we got pretty decent debt quotes relatively early in the process. And then it was just matching up the equity that would fit there. And I had been talking to a group called Peaceable Street Capital for a couple of years about a variety of different deals. And they are a provider of preferred equity. So preferred equity it's not debt. They participate in the upside, but they get a return before you get your return, and then they give you a return, and then everybody gets their money back, and then you split usually to the sponsor, meaning to our group, and they would provide 70 or 80% of the equity capital you put in the balance, but you're really at a riskier position than you would normally be if you were investing in a deal, because they get their money back first. So we had to offer those kind of terms because no other institutional capital. It was a large deal. It's hard to find private guys who can come up with $25 million.
Yeah.
So we had to offer those kind of terms to the institutional equity market.
Were you nervous about those terms?
I was, yeah. The issue, and generally we shy away from preferred equity. You got to find the right deal. You have to find a deal where you're highly confident that you're going to be able to
get out.
It's either get in or get out, or there's enough cash flow consistently to meet their preferred.
Because you have to pay that. Because the other investors. So talking about the last stack, which is the smaller friends and family, yourself, your friends, your neighbors, whoever it is. So they would not get a return after close because most of that return is going to the pref equity. So they would get were they getting any cash flow after you purchased it?
They were supposed to, in our pro forma, they were supposed to get some cash flow, but what happened during our period of ownership was interest rates rose enough to where the debt was getting more of the cash flow. So we were able to keep the pref current, but we didn't really make any distributions to the smaller friends and family folks.
Yeah.
We had 14 small friends and family investors.
14.
Yeah.
What was the smallest check?
The smallest check was mine.
Well,
it
there
was
you go.
Couple $100,000.
Yeah.
Just a little over $200,000, much of which I borrowed.
Yeah. Of those
So-
14 people, were there one that you were most worried about losing their money, or one that was the most, curious about what was happening?
I wouldn't say necessarily that. I worry about everybody's capital,
Yeah.
even Peaceable Streets, right? Or the lenders, right?
Yeah.
Because it's a responsibility. You want to, one of the reasons why we're able to go to people and say, please invest with us, is because we've been successful in shepherding their money back, usually with, with more money. And so we really don't ever want to lose anyone's money. My girlfriend was involved.
Yep.
So I didn't want to lose her money.
That's good. You're still together now.
Still together.
Okay.
And on top of that, my people who had invested in us for a number of years referred others of their friends to us. And so now it's friends of friends money. The first time they're ever investing with us. And so it's not just our reputation, it's the reputation of our other investors.
That's a lot of pressure.
Yeah.
So walking through that, I know callers raised helped you on the debt side, which is 40-ish million, and then you were able to get Peaceable around 20 million.
Yeah, 18.
And then the remaining amount, how much of those 14, what was the total amount for those 14?
So the total amount was $8 million.
Okay.
And the owner of Milan put in 10% of, he put in 2 million, 2.5 million.
Okay.
Thereabouts of that 8. We had another investor at $1 million. We had several people around 5, 4 or 5.
Yeah.
And then the balance of the folks were 250, around 250, including myself.
Yeah. That's amazing. So kind of moving from the transaction closed escrow in May, what's interesting about that time is that in May of 2021, I was looking back, and the 10-year treasury was at 1.5%.
Yeah.
And I don't want to fast forward to when you had to monetize, but when we got the offer for you, and there's a gap between, there's the value created, and I want to get to that next, but to fast forward, when you ended up selling the property, the 10-year treasury in October of 2022, when the offer came in, we ended up closing escrow in February 2023, the 10-year was at 4%.
Yeah.
So really, what I think is so interesting about this story is it really gets into your mentality on how these things are getting done, because there's a lot of things that innately you will have as a person that other investors may not be able to have to navigate that window, because you got in at a time where the pandemic was at the height in a lot of ways. And then there was a great run in retail fundamentals, leasing activity, occupancy, which is still doing well today. But then you had to exit, which ends up selling in February of 2023. Interest rates significantly gapped out. Yeah, during that, almost tripled during that time. So the window of getting in and getting out, and the date you closed, which was May of 2021, I believe, if my dates are correct.
Yeah.
It took, and for when we got involved to sell it again, and sell it for you, you were done within 13 months from when you ended up getting title, because we took it to market in August of 2022. Now, after you closed, I think we ended up selling that 2-tenant pad you mentioned, the Starbucks Cottage Health. We sold that for a 4.35 cap at $4,875,000.
Yeah.
So that amount immediately came back to you. Did you
pay down the debt?
Is that what you did? You paid down the loan?
That was the requirement. 95% of it went to pay down the debt, and of the other 5%, a portion of it went to pay down our preferred equity.
Okay.
And so, the small guys still didn't get anything out of that.
Yeah.
But just less obligations in front of them.
And did you lower the basis? What did the basis come down to now at the $61 million you purchased for? And
So the deal was we were moving. So the business plan was to sell off the pad almost right away. And the first thing that we had to do to sell off that pad was, I don't know if you remember, we got Starbucks to agree to extend their lease.
Yeah.
So it went from just under 5 years to just under 10. And that, I think, added probably 30, 40, 50 basis points to the
which
value.
Which is $500,000.
Yeah.
Let's call it what it is.
We were able to accomplish that within a couple, 3 weeks of ownership, and then just monetize that a few months later. So that was important. But the other thing that was going on was we were busy constructing a Rite Aid, and then once Rite Aid was moved, we had to construct a Ross. And so those things were already in play though prior to our ownership, and that was part of how we were the math. And then really the last pieces were fill in a little bit of incremental vacancy in one big box.
Yeah.
And the thing that really prompted the sale was we got Ross open, and got him open and paying rent. And then right around that same time, we signed a lease that went non-contingent with Ace Hardware to take the last big box. And that brought the center up to 97% occupancy.
And were you noticing, obviously, that the interest rates were going? I mean, I remember being at ICSC in May of 2022, and they were starting, that rate hike started almost in March of 2022. I could start noticing that it was starting to increase rather significantly at that time. Were you ever nervous about, was everything moving as you had expected them to move at the speed at which they're supposed to move, or were you starting to get nervous that, things are taking a little bit too long and the market may be shifting?
I think our execution on Camarillo was spot on. It was almost exactly what I anticipated. We did deliver to Ross a little bit late because we delivered to Rite Aid a little bit late.
Yep.
But I already, by March or April of 2021, I already knew that was going to happen,
Yeah.
So, but I think we executed really well. And so it wasn't that things were taking too long, but what really made us nervous, and I can't remember when you and I started talking about selling.
Yep.
But it was probably right around the time when I was about to sign with Ace Hardware.
It was exactly that. I remember looking back at the emails, and when you start off about why you like Camarillo, you mentioned that you also liked the fact that it had a lot of parcels, and you really your additional plan,
or it didn't have a lot of parcels. It had,
you could create. You were thinking that in the event that worst case scenario, you continue to parcelize these other aspects.
Yeah,
because there's a lot of value, which you notice in the Cottage Health Starbucks deal. I remember when we started talking about it and kind of going. I have a question first on the value, or after on the value creation, but to set the stage, I remember it was summer of 2022. I believe we were actually in Lake Tahoe. Weren't we at our house up in Tahoe around that same time? We were about to take Camarillo out to market.
Yeah.
But I remember that I was saying, I don't want to, look, the market's changing, but why not test the market? Because I don't want to sit here 12 months from now, 18 months from now, or sitting here right now with you and the value of the asset not be where we could monetize. I wanted us to be able to try it to see if we could have that execution. But kind of going back before we get into the final aspect of really the story, which is selling the property, when you look at the perfect execution on the value add and then really navigating all these investors on the buy, so far, what was the more stressful part of it? Was it the initial purchase or was it the value creation?
I think in this instance, it was the initial purchase was pretty stressful because we didn't have the money to do it.
Yeah.
We knew it was a great deal. We knew that people were walking away potentially from this fantastic opportunity to make money or to own long-term a great piece of real estate in Southern California. And so just coordinating all of those pieces and also buying something that's in the middle of construction has its own set of challenges because there were questions about how much the seller had already paid for construction versus how much we were supposed to pay. And we were supposed to pay for all the costs of construction. But at the moment that you close, it was how much had the seller already pre-funded, right?
Yeah.
And so you had to work through all those details. We had to work through we had to get comfortable with some details on the environmental condition of the property, which came up on the sale. And I had to keep the lender happy. I don't know if you remember, but our preferred equity retraded the lender. And then we ended up also during the acquisition, very, very reluctantly, our preferred equity provider made us buy an interest rate cap. So it's like insurance against interest rates going too high.
I remember that because we were looking at on the acquisition a potential credit, or we were trying to figure out and navigate that one piece, which is a small additional cost.
Yeah.
I love that you're bringing that up because when you went and sold the property, that initial cost that you had, how much did you pay for that cap?
So
and how much did you sell it for?
The cap was you have to call them like early in the morning and they'll quote you a cap. And then by 1 o'clock you close on it. And we were going to close on May, let's say it was the 10th of May, close on the 10th of May. And so the 10th of May, that cap was supposed to cost $310,000, let's say. And then by that afternoon, it was about to cost $325,000, but we couldn't close anyway. So I don't buy it. So 2 days later, when we were really in a position to close, it had gone up to $345,000. And so I was like, God damn it, it's another $20,000 for this stupid extra cap. We had to buy a cap no matter what, but we wanted to buy a 4-year cap rather than just a 2 or 3 year cap.
Yeah.
So So it costed, and then it was 3:45 the morning of May the 12th. By the afternoon, it was 365. So we ended up paying like 365 for it, let's say.
Yeah.
So that
I remember that time. There was. Yeah, I remember the calls. There were so many calls at night and early in the morning, and the roller coaster that you were on was, if it wasn't one thing, it was another. I mean, it was like a 5-month story that was just unbelievable. But walk us through that.
You'd call me and I'd say, I'm hiding under my desk. Yeah.
Yes. And I think it was
my hair was getting longer and longer and longer. I was like Dylan going electric.
I'm glad that during the value creation time, when you had everyone's money, you decided to groom. It was,
yeah. That was probably the most stressful time. And I think that's generally the way it goes with these value add deals, because again, you're buying something that no one else wants to buy.
Yep.
Right. And often, or maybe there's a few people that want to buy it, but the other thing about buying real estate and buying anything is it's really hard to buy it if you're the low bidder. You got to not only like have conviction about buying it, but you got to pay top dollar.
Yeah.
Right. I mean, there have been a couple of instances where we've been able to get a little bit of a discount because people know we're going to close, or because our terms are better. But generally, you're not stealing it. You're paying
betting
the best
on your
price.
execution skills.
Yeah. And so so I find trying to buy real estate the most stressful part of. I mean, obviously there can be some stresses later.
Yeah.
But actually trying to buy it and trying to execute on a value add purchase.
Yep.
Is oftentimes the most challenging thing, because no one else wants to do it.
Yeah. You know what's really interesting about that is this buy was, I mean, again, it was such a roller coaster of emotions throughout all of it. I mean, it was 1 minute it was up and it was down. I mean, when I first started this process with you, we kind of knew each other, but through that, just that buy
we didn't know each
side,
other that well.
We became friends. It went from, mutual respect to, we're like late at night comforting each other so we could actually sleep through that. Because I mean, in real estate, especially when you have a lot on the line, you will lose your sleep. Like you have to find that balance, and not to go on a tangent on what balance means and how to do it. But what I think is really important for people is they try to understand how deals are done. You had a core competency. You knew retail, you knew this asset class, you had the company and the team to execute on a plan. And that conviction was enough for you to have the confidence to continue to fight for the deal. And you could have given up, maybe 10 times and the deal would have died. I mean, at the beginning when you're raising
Sometimes
capital.
I was ready to, and you wouldn't let me.
Yes. I mean, the one thing I will say is, my role, it's funny, I'm optimistic like you, and you're optimistic. I knew I needed someone else to be optimistic to get it done, but a lot of our role is just to give you belief that you can do things and you can get it done. And, and that was the most exciting and the hardest part of it. But at the same time, going to the fast forwarding, now we're in a situation where treasuries are 4%. We're thinking about taking it to market. Now we're fast forwarding. Maybe it's July or August of 2022. I don't know the exact dates. I think
it turned from a large deal into a very big deal, right?
Yeah,
because of the value that was added.
Yeah,
and it's just that and all the institutional investors, again,
we're out of the market.
We're out of the market.
Yeah,
right.
And there were some challenges. So
they were really our exit. It's very rare to find a private investor who can buy an $80 million deal.
Yeah, and kind of going to the next phase, which is the sell side. Again, I'm always on the buy and the sell side. So the value creation side is something where I trust the people, and you obviously know what you're doing. But where I always see risk is, can you buy it right? Which you did. You contrarian, raise a capital. That was the hard part. But then I always lose sleep at night because, I'm saying, hey, this is a great deal. We can exit this deal. We'll be able to sell you this deal. And as the interest rates are going up in the market, I'm starting to lose sleep because the buy is fun. You're excited. You're going after it. You may be losing sleep. The execution, you're in your core competency. I'm out there doing other things. We sold the 2-tenant deal, but we're not in the day-to-day with you on operations. But then when it was time to sell, you start and look at that return on cost, which is basically your exit. If we end up selling at a 6 3/4 cap rate or 7 cap, which is, I'm not saying that's where the market was at that time. And I do think the buyer has an awesome property that he gets to own, and he's private. So they're a private group. So they look at the world a little bit differently than maybe an institutional capital. So I do think it's a good project for them long term. But now if you look at where the investment market is, very easily deals that are grocery anchored, maybe not this one specifically, we're selling them, they're in the high 6, low 7 caps. The value you would have
Depending on the
had,
location, right? I mean,
yeah, some in the mid 6, not this one specifically, but
I think looking forward, that's probably high 6, low 7s is
yeah.
where things are going, right? At least for the next couple of years.
And your execution, the revenue and the profit would have drastically changed.
We wouldn't have sold it over 7, I don't think.
Yeah, because you break it up.
We would have need to, yeah, exactly. We would be starting to break it up. We would be doing some other things. We're supposed to, in the pro forma, I think we're still supposed to own it.
Yeah.
Are we still supposed to
You're
own
supposed
it
to still own it
until May of 24, I think.
You made the right call. But again, I remember taking it out. And so kind of where I saw it, and I remember clearly. So the sales side, when we had it out, we took it out without a price, right? You did a phenomenal job making it look great. And in that process,
we extended the leases for a bunch of people as well, which I think made it even more stable for whatever that was worth. But I think that was worth a lot, right? Especially for the private individual investor to see that they didn't have to have a lot of rollover risk.
You create a lot of not only revenue, dollar amount value, but you were also able to stabilize it and position it because what the private sector looks at is you're raising capital on that side.
There was more yield and more stability of that yield.
Yeah. So kind of going through and when we looked to exit it, I remember that we were going to do, we're going to take it out on price. We wanted to test it. I didn't want to lose sleep in selling because the plan was to sell it in 2024. But I just felt like if the market's going to turn, why not take that shot? At the end of the day, you don't have to sell. So if it works, it works. But when we went through the call for offers process, prior to the call for offers, 2 weeks after we took it to market, we found a great investor who was in an exchange. They were, I think it was $88 million they were selling out of an asset in Texas. I don't think they purchased retail before.
They're selling up 4 apartment buildings in Texas, I think.
So it was the first deal that they look at. I remember getting the offer in. And a lot of our clients, and just a testament to you as well, not only the entrepreneurialism on being able to fight to buy it, not only the core competency to create the value, but to be able to be flexible on the sale is something that you may not recognize you have. I'm always on the sell side, so I always see people that say, this is the process. Take it out, do a call for offers, do a best and final, buyer interview, push one guy to the max amount, right? Which is, especially on deals that are 100 million, that's the way things should go. And there's no diversion to that. But I remember your flexibility when the offer came in. We immediately countered back. You were very attentive. You were very focused. And then we did a buyer interview. Once we came to terms or very close to terms, we did a buyer interview. And generally on buyer interviews, and this is where another testament to you, usually it's, how do we know you're going to close? Where's your capital coming from? We're really putting pressure, as we should, on the buyers because we don't want to fail escrow. We want to make sure that as your advisors that we don't spend money on legal and all these other things and have a failed transaction because it hurts our brand and reputation. And so I remember going into the call, and I think you and I spoke beforehand, and we were like, yes, it's important to vet them, but you went right into sales mode, like the same level of skill in selling this asset to the capital prior to buying it, the vision of what this, and then once you finish the vision, that buyer interview question was honestly you making the asset sound incredibly good in front of them. It was you basically making them feel like this will be the easiest transaction that they do. You relating to them because you've been in exchanges before, right? You were going to buy with exchange pros. A lot of larger groups, they don't recycle that way. And so for you, you really connected with them on that level to where they felt like you were one of them. And I feel like after that call, that was a critical juncture for us because after that call, they were looking at assets. I remember they're looking at an asset in Denver. They're looking at industrial. They're looking at different asset classes. And ultimately, look, I think it's a great property for them. And I believe you continue to help them with the management of that property. But I'd say that, that proved out, but your ability to be open to what a buyer interview it could be in this instance and pivot was a huge difference. Walk us through that. Do you remember that day?
Oh, definitely.
Or that time?
Yeah. I mean, I think the market was changing so much at that time that because the interest rates were rising, there was a lot of uncertainty. There had been this big sucking sound of, again, all the institutional investors, not necessarily running away from this product type in particular, but just saying, hey, we're pencils down on everything until we understand where interest rates are going.
Yeah, exactly.
Whether the economy is going to go into recession and, no one wants to get fired. And so, so it really felt like a different world. And then on top of that, I recognized that in this instance that buyer in particular had a lot of concerns. They never owned retail. And for the last 15 years, retail had been had been maybe the worst product type, right, of the major food groups, right? Between industrial, office, apartments, and retail. Retail was the dog for, a decade and a half. We always liked it because, we have cash flow is great. And
a lot of it was perception too, right? Meaning that
perception,
the Amazon effect, people felt that way. But you and I, especially you being in the trenches, knew that it may have been the outcast, but almost unrightfully so in some ways, right? Yeah. It was an asset that still had viability. Because coming out of the pandemic, things really went well.
And I think coming out of pandemic, it took probably the general public a lot longer, and even the investing public a while to realize that the pandemic actually really helped the retail industry in a lot of ways. First off, there's been no new construction. There'd been no new construction since the late, 2000 aughts or whatever, it's 2007, no new construction. So there was less retail. A lot of the weaker retailers had already gone bankrupt. Some of them that we thought were going to go get bankrupt were able to recapitalize at lower interest rates and come back and start to expand. And so suddenly we were in a place where where absorption of retail space was great. Even coming out of the pandemic was and continuing today, we're running out of space and in our retail centers. And so convincing somebody who had never bought retail before of that, and also of the ease of owning a retail property, which is complicated, but we made it a lot easier by adding all that term, was something that I felt like we really needed to do in this instance, just because there weren't a lot of buyers, and the price was good. It wasn't as high as we had initially been hoping, or as high as it could have been had we tried to sell like 6 months earlier.
Yeah.
But it was a great price.
Yeah.
And so we were able to, so I really just felt like it was important to get these guys comfortable with the asset.
Yeah.
And I still am a believer in it.
But I think that moment in time, and just the fast forward for the people that kind of can see this, is that the flexibility and the trust you built on that call was a difference maker, because the buyer did not even open up. I don't think they signed a purchase and sale agreement until a few days prior to close.
Oh yeah, that was the weirdest. It was the strangest.
And they're spending money, right? So there had to have been a trust there.
Yeah, that was the biggest deal we've ever done, selling to them, and it felt like almost like buying, like we're flipping houses in terms of the level of of how fast. It was a 2-day escrow. We were in talks for months and months and months. Right. And then there was an environmental problem. There was a dry cleaner. And so there had some just indoor air quality testing that we had to go through, and all that had to be machinated through. And so it took forever. But when they finally closed
at 83,715,000, change.
Yeah.
So in 2 days, I'm trying to go back. Did they actually put a deposit in, or they just put the whole 83,750,000 in there? But
I don't know that there ever was a deposit.
I think they just put all of it in.
I don't think there was. Yeah, I mean there was almost like no time.
Yeah, but they were spending a significant amount of money.
They had spent a bunch of money doing
they were in an exchange, so they had to close by a certain date too. So there was an issue where, could we deliver the asset to them prior to the expiration of their ID period?
Right.
And if we didn't, they had other opportunities to buy.
I think they had already ID'd.
Yeah, they'd already ID'd. But they had more than just these assets. They could have pivoted if we couldn't close it. We couldn't deliver to them. They already
closed on one. We're probably going to take over management of that one too.
Yeah.
So,
which is great. I mean, I do want to segue to that.
Yeah.
I mean, I think people would love to actually finally hear at some point in time, what did the investors get back, or what was the dollar amount that you got? And then I want to segue into, because you made a interesting comment, you're doing management for them on another asset. So there's even a relationship post-close in the situation. And I feel like one of the really cool stories is not only the mentality that you had and the desire and the hope but it's like personalities coming together. I feel like sometimes buying and selling, it's a marriage between the two. There are so many relationships that were pulled out of this.
Yeah.
And I want to talk about that for a second, then we'll get back to kind of what the investors got. But, for you, you and I really built a friendship. It's been a blessing to have you as a friend, and I'm excited for the next deal. I think right now you're seeing the market where office is struggling, so you're probably focusing some attention there, and we can get to that. But, the friendship was built. What's also cool about, for me, I got a partner here at Colliers the person who was running transactions when you purchased the property.
Yeah.
He was there. He was the one that called me and said, hey, here's Camarillo. He ended up joining our team in January of 2023, and he was the one that actually helped manage the deal to closing.
Right to the day of closing.
So I got a relationship with you. I got a new business partner, and then walk us through now. You got the management for the asset you sold and potentially another asset that they own.
Yeah, absolutely. And so I think our philosophy is always that a deal is not a good deal unless it's a good deal for both sides. And so we try and make it as easy as possible. We try and be as open and honest as we can during the transaction, within reason.
Yeah.
So it's never nothing but the truth. Not necessarily always the whole truth.
Yeah.
But nothing but the truth. And I think that I built a great relationship with Ryan, who's now joined your team.
Yep.
During that transaction as well, where problems would come up, he would call me about them.
And he knew it because he owned the asset too, in some ways, right?
Exactly.
He was an owner of that asset probably longer than you were.
Yeah.
At the end of the day.
Well, much longer.
Yeah.
Yeah. Much longer. So when something would come up that he needed to disclose to us, he was Johnny on the spot telling us about it, and we figured out a way to work through it. And so he was great through that transaction. And I tried to be the same with him. If we were having problems,
Yes.
hey, we need a few more days here, a few more weeks here. Here's the things we're working through, but here's what we've already done. And so maintaining that relationship throughout what can be a pretty contentious and difficult process.
Yeah.
Because really they're trying to get the best price. You're trying to get the best price. And same way on when we're selling, we're trying to get the best price and they're trying to get the lowest price.
Yeah.
Right. And so working through all those details and also making sure that they're aware of things, eyes wide open going into a deal so that they understand where they may have problems with you.
Yeah.
What physical issues that need to be addressed.
Yep.
So just being honest with folks as much as you can, and keeping that relationship is really important to us, because we not only are we folks that when the last 5 commercial properties, we retained management 3 times.
Wow.
So we've kept a relationship with the buyers of properties that we've sold.
That's
to
great.
where they're entrusting us with the management of that asset.
Yeah.
So obviously we want to keep that going, but also we have one group from whom we've bought multiple times, and so we want to make sure that we have that good relationship going forward with the folks that are selling assets.
Yeah.
So they know, like, hey, let's talk to these guys, because even if it's a difficult transaction, even if it's not fully baked, we know that they can get in there and fix it. And so maintaining those relationships is really important. And I think the key there is communication.
And sometimes our business relationships are the most valuable thing.
Yeah.
But let's get to the other aspect of it. You bought it in May of 2021. You exited in February of 2023.
Yeah.
How much money was made?
So
'Cause that's a very short period of time.
It's a very short period of time. It is the second shortest amount of time we've ever owned an asset. It's an extraordinary, especially for an asset of that size, it's an extraordinary amount of time, extraordinarily short amount of time in which to add as much value as we did. So the investors, we put in 26 million. We got back 45 million in proceeds, which
Wow.
And due to the structure of the deal,
I'm just trying to do math here. 45 minus 25 is 20.
$20 million of profit
in 18 months or so, 20 months.
21 months.
21 months.
Yeah. And
so that's $1 million a month.
Close. Yeah. About $1 million a month. And even more importantly, in terms of the way that we had structured the deal, the pref equity was very, very happy. They achieved about a 20% IRR. So they got their goal is to target kind of low to mid teens. So 13 to 15%. They got 20.
Yeah.
But our smaller private investors doubled their money in 21 months. That's
great.
It's an incredible return.
Which includes you and your girlfriend.
Which includes me and my girlfriend.
So are you buying dinners or she's buying dinners? Is that,
Both.
Does it go either way?
Right. We don't go Dutch. We never go Dutch.
Okay.
But we treat each other. But no, it was fantastic. And we were lucky enough also, back to that interest rate cap.
Yeah.
That thing that I was complaining
you
about.
lost sleep over $365,000.
Yeah.
How much did you make on that?
I was bitching about the fact that it was 20,000, 60,000 more than what it was Monday to Thursday when we closed. Because interest rates had risen so much, it was a 2% interest rate cap on SOFR. SOFR went to 5, and it was based on a value of $40 million. We were able to sell it back to the folks that we had bought it from for $2.5 million.
That's insanity.
So that was the 10%, more than
Wow.
10% of the profit was.
And that wasn't luck. You knew that was going to happen. That was skill.
I had no clue. In fact, we even discussed, hey, is there any value you need to
Yes.
sell earlier? Is there any salvage value? And the guys we bought it that were arranging the purchase of it from, were like, not really. No, usually, maybe it costs you $10,000. It costs you $10,000 to get rid of it. Like this kind of thing.
Wow.
So no one anticipated this thing. But I remember I was reading the Wall Street Journal, and there was a lot of folks who had the kind of loans that we did, where it's a requirement to buy interest rate caps of some term. We bought an extra long one, but of some term. Their problem was, as they came up to extend their loans, they had to extend the caps too, and those prices were going through the roof.
Yeah.
And I started scratching my head and said, "Hey, wait a second, this is extra value here," and that enabled us, I think, also to better meet the market. Right? We may not have wanted to sell at that price if we didn't have this better value. Yeah.
Wow.
So we had that somewhat baked in.
That's unbelievable.
Yeah.
All right. So I mean, it's clear to say that when someone reads, the press releases or reads CoStar and sees Milan Capital buys a deal at 60, because it probably doesn't even show the renovation dollars, shows 61.5, and then they see $5 million on the pad and $84 million. I get a lot of calls because they see my name on selling it to you, and then they see my name on selling it to somebody else. And that's why we started this whole conversation, is that they don't realize what it takes to actually get that done.
Yeah.
What would you say was the one or two things that you think were most critical in the process? I mean, there's some good positives with the cap. That's a great story. What would you say were the one or two things that really kind of made the deal? Was it the purchase? Was it the execution? What was it?
I mean, I think that they do always say that you make your money on the buy, right? And of course that's true, but you do also have to be willing and able to sell and to meet the market when the time comes. I think in this instance, is having the relationship with you where you felt like who's the one guy, who's the one group that could get this thing done now. And
I called 50 people before you, though.
Yeah, that's probably true. Having the fact that we had been trying to do a deal for years, and I can't remember if we'd ever done one before.
It was just fate. We were seeing each other right when this deal was happening.
Yeah,
and it was almost where.
And Charlie had joined your team shortly before, and I had a long relationship with Charlie.
Exactly.
I was on Charlie's first date with his wife, accidentally.
Wow.
And he was at the restaurant on his first date with his wife, and I happened to be there with my family. And and so I had known Charlie for longer than I known you. And so all those things came together to the point where, and also at the moment that we did it, no one else was really doing transactions.
Do you feel like it was meant to be for you? A part of it was it?
Well, I never feel like that. I never feel like that. I mean, I feel like it's great to be lucky, and in this instance, I think we got lucky on a number of occasions, and I never consider myself a lucky person. But I do, but I think like it's a lot more challenging than people think, because first of all, you have to have the conviction. Yeah. And then you have to figure out a way to get from point A to point.
But the conviction was based on your core competency.
Yeah.
If you did not have belief in your ability, you saw a plan.
Yeah.
Rite Aid moves here, Ross comes in. You knew that you were confident that you could execute on that. And the only thing that you couldn't control was the exit.
Couldn't control the exit.
Maybe the market goes there, maybe not.
Yeah.
But that one difference was what made it. Like I said, every person comes to me and says, so many people come to me and say, man, I wish I would have bought in 2010 or 2009. And then this next time when I have the money, I'm going to buy. They say that, and then 2020
go buy
hits. Yeah, exactly. Well, we could talk about that. But, 2020, it's one thing to say that you're bold and you're brave and you can buy things. But it's another thing, hindsight's 2020. It's another thing to actually do it. And I just was amazing to see, that come through, and your optimism throughout the process, I think, was a major. Even though you may not think you're the luckiest guy, I don't think it was ever luck. I think it was just truly you had belief in yourself and your team and the process, and that's what created the sale.
It just made sense. It was exactly what we do. We've done a lot of redevelopment deals in the past. We've stepped into construction projects that were. We're not managed as professionally as this one was, and we were buying from an institutional seller too.
Yeah.
So it felt like something that we definitely could do. And again, like what I've been saying to everybody for months, and I got a chance to put my money where my mouth was we'll be rich or we'll be dead.
So give me, I love that.
Triple vaxxed. Who knew?
Who knew?
Who knew?
The
I
last
don't
thing,
think the vaccine wasn't even available, right? Until like,
no, it was, The last thing I'll ask you, and then I want to get into charity. We do a lot of charity work, and we're going to do some donations for you. But before we do that, you've seen the market. You went into a time that was very scary at that time to buy retail. Where's the opportunity right now that you see? If are you buying stuff? What are you buying? I guess you can't be too you can't tell too much about it. But what's some of your advice to investors that want to make some money in this market?
Well, I think looking for opportunities right now, the easiest, the place where things are the most undervalued is definitely the office market. The office market's particularly challenged from a fundamental perspective. And so I don't know that necessarily you got to be really careful. The office market was kind of, even though it was a more favored product type than retail in 2019, it was not a better business fundamentally, because there's been dramatic overbuilding in office, or there was dramatic overbuilding in office in the 1980s. And my whole career is 30 years long. From the early 90s, we've been battling against overbuilding in the 80s. Yeah. And so the office market in Southern California, when it goes below 10% vacancy, a recession is coming. And that's been the case for my whole career. And so even prior to the work from home, trend, the office market was already challenged. Now it's even more challenged by work from home, plus construction costs are going up and up and up. And even tenants who are calling people into the office, they're still not having people working, 5 days a week, right? So the demand for office space is slackening but the prices now, you're able to buy at 1/5 of replacement, I think. Like they say it's 1/3 of replacement, but when you look at construction costs, it's easily 1/5, 20% of replacement. It's amazing. Yep. So you can buy an office building, a Class B plus office building in Orange County today. There have been multiple transactions at $110 a foot, and I will not be surprised if we see those values fall below 100. You have to know what you're buying, and you have to know what you're getting yourself in for. Yeah. And once you have bought those office buildings, if you buy something for $100 a foot, you're still $50-$60 a foot away from stabilization. And today, office buildings are trading for $160 a foot and 10 caps. Yeah, 10 caps on existing. So you might stabilize to a 9 cap and $160 a foot, but it's the lower of those two numbers. So you might have something that you spend $160 a foot on, but you're at a 9 cap, so it's worth 140. Yeah. So you really got to be really cautious.
It's a different animal from the fact that retail was overbuilt, and at the time that you purchased it, it wasn't. The fundamentals were back. Yeah. The ramp up of market rent, and now vacancy factor is the lowest has been across the US for retail. Yeah. So really your concern was, can the capital markets be stable enough for it to be exiting in the mid 5s? With the office, it's been hammered incredibly hard to
from every angle,
the price per square foot. So the fundamentals that help you go and raise capital for retail, the conviction can still be there for you, but it has to be very, very selective, because you have to also bet on the exit in some regard, that it doesn't go to 12%, it goes down to 8%, 9%, and that's a gut feel. So it's a combo. So what I'm hearing from you,
in a rising interest rate environment, it's hard to bet on cap rate compression.
Yeah. Well, listen, I look forward to the next deal that I see you purchase and reflip.
Might be an office building.
If it is, I don't do office, but I will give you some money. I want to triple. I want you to triple my money.
Right now, we're looking at a mixed use property with medical office and retail, and we're looking at breaking it up. And it's a creative deal, and we're really excited about it. I think it's going to be a great opportunity, we're not the low bidder, but it is a product that people are.
But you close 90% of the time.
We close 90% of the time.
Yeah, so there, you don't have to be. You don't.
It might take us a while.
Yes, it may, but it's always worth it.
Yeah.
The last thing I'll leave you with is, I think our brand is all about giving back.
Yeah.
It's people always ask me what you do.
That.
Yeah. And what we do is we sell shopping centers, but why we do it is because we want to serve the communities that these centers are in. And so every deal that we sell, we take a portion of those fees and we keep it for future charity opportunities. So today, I want to make sure we give a donation for a charity of choice for you, not only for Camarillo, but for taking the time with us today. Maybe give us a charity that you think is worthwhile, and we'll make sure that we make a donation for you.
So the charity that we've chosen is Habitat for Humanity, which is a group So I came from the affordable housing business. I was in affordable housing prior to moving to commercial real estate. And so was involved in building and managing apartment buildings in low-income areas for low-income people and providing services to those folks. And we think Habitat for Humanity has been one of the most enduring nationwide providers of affordable housing, created thousands and thousands of units. They oftentimes bring volunteers in to help people build homes. They do not just for rent, they do for sale housing, getting people the benefits of home ownership that they would otherwise not be able to get. We think it's a great charity, and the owner of our company's been involved with it since before I met him 20-something years ago.
Amazing.
So that's the charity we'd like to choose.
Great.
Yeah.
Thank you for your time.
Thank you.
Yep.
All right.
If you enjoyed today's episode, please join us over at nationalretailinvestment.com to connect and stay up to date on the latest commercial real estate investment insights and opportunities nationwide.